of the ultimate goal of the $1 billion rescue fund operation is to attract and leverage more private capital and social resources to join in the reconstruction of market order and confidence. This means that the problems caused by the greed of many players on Wall Street will ultimately be solved together by these players. As for the possible changes, whether it is directly controlled by the government, serving as both a judge and an athlete, or investing in private capital, investing in non-performing assets, the government's return from the front to the back means that it is difficult for the government to stand on the opposite side of private capital or market players. Mixed operation and joint cooperation may become new features of the next stage of the financial market. From the trend of mixed operation between commercial banks and investment banks, it can be seen that commercial banks have not been spared this time. With the support of investment banks and hedge funds, improperly taking on the risk of excessive home buyers and the excessive debt of investment banks themselves supported by credit products, the combination of the two may lead to further deterioration of the problem. Therefore, after the dust settles, after a period of repair, commercial banks are likely to repackage and sell their investment banking business, and the investment banking model will obviously not end. However, the transparency and leverage ratio of its derivative trading, including executives, will be strictly required and restricted. In fact, entering the financial civilization, the existence and reproduction of financial innovation and financial derivatives has become an important economic approach, which undoubtedly has a gambling nature, is inherently guilty of surplus liquidation. Therefore, this requires innovation in trading methods to adapt to the development of derivatives. In fact, the financial crisis is causing the global financial market to fall into painful reflection, making the United States and other countries, including the United States, face the challenge of the Washington Consensus. Although the major countries in the world have coordinated their actions to cut interest rates and inject capital, it is not difficult to imagine that after the crisis, the opening of the financial field of all countries will be cautious and explore the development path of the virtual financial market for the battlefield. In the short term, financial civilization has stagnated, but in the long run, with the recovery of investment banks, confusion between governments and financial institutions, especially the weakening of Wall Street's financial power center, which once dominated the game rules, and a decrease in trust, the international financial derivatives market will eventually become a large casino with relatively open and fair rules, where countries or institutions gamble for high profits. The financial derivatives market is moving towards casino-like, serving as a safe screen for the virtual economy to directly affect the real economy obstacle, adjusting economic imbalances before they harm the real economy, becoming a place for excess evaporation with dissipative functions. But this is only a possible trend in the international financial market, and whether domestic derivatives in China are heading towards casinos, the key to success lies in whether While accepting the double-edged sword effect and abstract affirmation of financial derivatives, we can leverage the advantages of latecomers, absorb and learn from them, and improve the barrier role of the virtual financial market. This first means separating rather than mixing. Of course, this is not to say that banks, securities, and insurance are completely in their respective positions and functions, but to set up firewalls to separate high-leverage off-balance sheet banking and financial derivative investment business from traditional banking business, in order to ensure the bottom line of deposit safety. In addition, a firewall is set between market failure and human greed. For example, the income of the boss is no longer just the final say decision of the market. Next, improve the order of the casino. Ensure fair, just, and open trading rules and information, so that participants can be willing to gamble and admit defeat. The misconception of price crossing was the most difficult year for decision-making in China. The situation is chaotic and complex, with various elements blending into different arrangements, the combination of policies. And behind the complexity lies the confrontation of interests and strategies, which makes it difficult for relevant parties to understand the situation. However, policies that have been overturned have been repeatedly taught by the market, such as price limit orders and external limit orders, which are equivalent to diminishing usage. Multiple equilibria are leading macroeconomic regulation towards macroeconomic coordination, but this does not mean that the original path was wrong, but rather that the space for success has been squeezed out. The reason why decision-making is so difficult is that the logical clues to the crux of the problem have not been sorted out yet, and we don't know how to take the path of comprehensive marketization. So we can only lie on the ground, just as we have just become familiar with the marketization of consumer goods prices. Its history quietly passes by, while the prices of production factors a crisis is brewing. Firstly, asset prices are facing deep adjustments. The stock price has been halved, bank wealth management products have disappeared, private equity and QDII have been liquidated, and land prices have performed a roller coaster. The turning point of housing prices is in direct confrontation with diving, and credit has tightened the funding chain of some real estate companies, leading to an asset price crisis. Secondly, the prices of resource goods are all trending red, although domestic resource prices have not yet been fully liberalized. The surge in international oil prices, grain prices, gold prices, and other factors has driven domestic prices to skyrocket, causing fluctuations in non-ferrous metal prices. In March, the factory prices of crude oil and raw coal increased by % year on year. The inverted oil prices both domestically and internationally have caused oil giants to suffer more and more losses, with Sinopec's performance declining by % in the first quarter and frequent oil shortages. Thirdly, the labor price crisis has been released early by domestic and foreign factors. The subprime mortgage crisis has brought about massive layoffs in the financial industry. In the past 9 months, Wall Street has laid off more than jobs. Global inflation has kept wage growth from keeping pace with CPI growth. From American writers to NDH police to British teachers, strikes have become a means of demanding wage increases. The domestic labor cost has also been steadily increasing due to the implementation of the new labor law, the increase in minimum wage standards, and the mismatch between labor supply and demand. In the first quarter, the average salary of urban on-the-job workers increased by % year-on-year, while pilots' resignation, elopement of publicly raised funds, exposure of sweatshop, and the spread of migrant labor shortage have become the external manifestations of the labor price crisis. It seems that the crisis in factor prices has arrived early. Coal, electricity, and the prices of resource goods such as oil, gas, water, land, and production factors such as labor are becoming increasingly uncontrollable, forcing prices to enter a second round of breakthroughs. On the one hand, China's production factors are already low, with industrial electricity prices only accounting for 4% of developed countries such as Japan and Italy, urban water prices only accounting for of international water prices. Labor productivity equivalent 2% of the X, but wages only %. Globalization has inherent driving forces for domestic production factor prices to align. On the other hand, according to Citigroup's latest conservative estimate, the overall cost savings of industrial enterprises due to price distortions were approximately trillion yuan, accounting for nearly % of GDP. The cost of production factors is artificially suppressed. Not only does it not reflect the true cost, but also artificially overestimates profits. Some scholars estimate that domestic enterprises will unreasonably save at least % of production costs as a result, assuming that the enterprises themselves absorb % of this product. Prices will also increase by at least %. Therefore, the market's reconfirmation of production factor prices is an insurmountable barrier. In fact, if prices are distorted, they should be reformed. But the reform of the price mechanism is hesitant. Reform faces difficulties and the inability to rationalize prices. The essence of price crises reflects the crisis of reform, and the inability to promote reform lies in ideology. If there is a problem with ideology, it is a crisis of ideology. Our country is a country with several levels of civilization and several days of complex IT, which cannot be compared to other countries. However, with knowledge at its peak and a superficial grasp of complex situations, using classical Western theories and thinking and methods under agricultural civilization to respond will undoubtedly encounter bottlenecks, making reform difficult. Therefore, the ultimate solution to the price crisis lies in the renewal of ideas. It may be a necessary condition for emancipating the mind to subvert cognitive inertia and the old truth standards with the idea of post-industrialization or even financialization. Even if we can keep up with the times in our thinking, the path of institutional reform remains bumpy. not to mention the resistance of some special interest groups to reform. The living pressure brought by global inflation alone has made it difficult to reconfirm the prices of production factors, let alone the fact that price reform is now facing two major